Hello everyone. Today, we will talk about sources of equity financing. Raising funds for a new business has long been a significant challenge for entrepreneurs, influenced by fluctuating capital markets and changing economic conditions. The dynamics of capital markets respond to the stock market, overall economic health, and investor sentiments, making the search for financing feel like a roller coaster ride. This uncertainty has intensified since the financial crisis of 2008, leaving many entrepreneurs, particularly those in less glamorous industries or those just starting out, struggling to find outside sources of financing. Banks often hesitate to lend to startups. Venture capitalists increasingly look for larger deals, and private investors have become more cautious. Consequently, securing funding, especially for amounts between $100,000 and $3 million, becomes particularly challenging. To navigate these obstacles, entrepreneurs can adopt several key strategies. First and foremost, selecting the right sources of capital is essential, as this choice will influence the business for its entire lifespan. Entrepreneurs should take their time to research funding options, understanding which sources are most suitable for various stages of their company's growth. Creativity is also vital. Just as they innovate in their products and services, entrepreneurs should approach financing with an inventive mindset. Moreover, the Internet offers a wealth of resources, including crowdfunding platforms that can significantly expand their funding opportunities. When raising capital, it's important for entrepreneurs to aim for the right amount. Insufficient funding may lead to cash shortages before reaching profitability, while excessive funds can tempt entrepreneurs to incur unnecessary expenses. Being well prepared with a solid business plan is crucial when approaching potential lenders and investors, as clear, concise presentations can make a substantial difference. Additionally, focusing on smart money, investments from sources that align with the entrepreneur's vision, can enhance the likelihood of success. Entrepreneurs should also be mindful of planning exit strategies for their investors, as this demonstrates foresight and increases the chance of securing needed capital. Instead of relying on a single funding source, combining capital from multiple avenues, often referred to as layered financing, can provide a more robust strategy as the business evolves. Early-stage funding might come from personal savings, family, and friends, while crowdfunding and angel investors may be appropriate as the business grows. High-growth ventures might later attract venture capital, supplemented throughout with various forms of debt financing. Planning for capital needs is a crucial aspect of becoming a successful entrepreneur, and it often requires more time and energy than founders initially expect. The initial funds necessary to launch a new business, referred to as seed capital, can consume up to half of an entrepreneur's time and may take several months to secure. The sources of this seed money can vary significantly based on the nature of the business. For instance, a technology startup may have different capital needs compared to a local ice cream shop. While both entrepreneurs might seek similar types of funding sources, they will be more effective if they target specific investors or lenders aligned with their respective business models and financial requirements. However, the need for capital doesn't end at the startup phase. After establishing the validity of their business models and attracting a customer base, entrepreneurs often need additional funds for growth, known as growth capital. A pertinent example is a small healthcare software company that initially focused on small-town hospitals. To expand, the company sought larger clients and successfully secured a contract with a national hospital chain. This new venture presented challenges requiring significant investment in staffing, equipment, office space, and technology infrastructure, all of which necessitated growth capital acquired from investors. These investors typically expect their contributions to enhance profitability and cash flow, ensuring a return on their investment over time. Capital, broadly speaking, encompasses various forms of wealth that businesses use to generate further wealth, including cash, inventory, and fixed assets like buildings and equipment. Entrepreneurs typically require two types of capital: fixed capital and working capital. Fixed capital refers to funds utilized for the purchase of a business's permanent assets. This includes investments in buildings, land, machinery, and technology. Such investments are considered frozen, as they cannot be readily redirected for other uses. Fixed capital usually involves significant sums, with investors expecting long-term growth and returns. If financing is secured through credit, the loans generally have extended terms, based on the understanding that these fixed assets will generate sufficient cash flow for repayment over time. Working capital, on the other hand, involves the temporary funds necessary for day-to-day business operations. It is calculated as current assets minus current liabilities. New businesses require working capital to cover operational expenses until they reach break-even and generate positive cash flow. For established businesses, the need for working capital often arises from cash flow fluctuations due to seasonal sales variations or timing discrepancies between sales and customer payments. It is critical for covering inventory purchases, paying bills, financing credit sales, and managing payroll. For startups, equity financing is a common source of working capital, helping to launch operations and achieve growth potential. In contrast, established businesses typically rely on lenders for working capital needs, with the expectation of prompt repayment as cash flows into the business from regular operations. Sources of equity financing. Equity capital encompasses the personal investments made by business owners and any external investments in their venture. This type of capital is often referred to as risk capital because investors shoulder the primary risk of losing their funds if the business fails. However, if the venture succeeds, both founders and investors can reap significant rewards. Historical examples include the founders and early investors of companies like Yahoo, Sun Microsystems, and Microsoft, who became multimillionaires when these firms went public. A primary advantage of equity capital for entrepreneurs is that it does not need to be repaid, unlike loans. Equity investors typically expect to share in the company's earnings and often seek a voice in its strategic direction. On the downside, the main disadvantage of equity capital is that entrepreneurs often have to relinquish a portion, or even a majority, of their ownership to outside investors. While having 50% of something is better than 100% of nothing, giving up control can be unsettling. Many entrepreneurs who lose majority ownership or agree to stringent terms from investors may find themselves ousted from the companies they initially founded. This tendency to cede equity is most pronounced during the startup phase. Entrepreneurs can draw from several common sources of equity capital. Funding from founders. The first and often most accessible source of funding comes from the entrepreneurs themselves. This self-funding is typically the least expensive option available and is crucial for many startups. Surprisingly, the amount needed to launch new businesses isn't always large. More than half of startups launch with less than $50,000, and nearly half of those without employees begin with under $10,000. Investors and lenders usually expect entrepreneurs to invest their own money, as a lack of personal investment can raise doubts about the commitment of the entrepreneur. Personal savings. A typical source of startup funding is personal savings, which can include funds from savings accounts, cash from investments, and withdrawals from retirement accounts. This capital can be used for equipment purchases and cover living expenses until the business generates enough cash flow. Entrepreneurs often forego their salaries during this phase, which is known as sweat equity. It's recommended that they have sufficient savings to manage both personal expenses and initial business costs for at least 6 months. Other personal assets. Many entrepreneurs may already own equipment necessary for their new business, such as computers or vehicles. Instead of spending cash on new acquisitions, they can leverage these personal assets as part of their business investment. For instance, partners starting a venture together can assign fair market value to the equipment they contribute, counting it toward their overall investment. Unsecured personal credit. While banks typically do not provide loans to startups, entrepreneurs may secure personal loans via credit cards or lines of credit. However, using credit cards can be risky, as it puts personal credit ratings on the line if the business fails. Many credit card companies also prohibit business use, which can lead to complications. Second mortgage on property. For entrepreneurs who own a home with significant equity, a second mortgage can be an option to finance a business. This route, while feasible, carries the risk of personal financial obligation if the venture does not succeed. Pledging other personal assets. Entrepreneurs with valuable personal assets, such as stock or rental properties, can use these as collateral for business loans. This approach is risky, as failure to repay can lead to loss of the pledged assets. Working a second job. Many entrepreneurs continue working while launching their businesses, a strategy known as extending the runway. This approach provides them with additional time for their startups to gain traction before taking money out of the business for personal expenses. They may work during the day and focus on their venture during evenings and weekends, sometimes retaining their secondary jobs until their business can support them financially. Bootstrapping. Finally, many entrepreneurs resort to bootstrapping due to the challenges of attracting outside capital. This means finding creative and resourceful methods to launch and run their business with minimal funds. This approach requires boldness and ingenuity, but can be effective in navigating the financial constraints of starting a business. Friends and family members. Many entrepreneurs begin their funding journey by looking to their own resources, but often find they need additional support. After tapping into their personal finances, friends and family can be a vital source of capital. According to research, family and friends represent the largest external funding source for new businesses, contributing significantly to startup capital, about 36% in the US alone. While the sums involved can be modest, typically a few $1,000s, these investments can help entrepreneurs get enough traction to attract larger investments. Key considerations. Investing from friends and family can strengthen a startup, but it also carries risks. Unrealistic expectations and misunderstandings can lead to strained relationships. Therefore, it's essential for entrepreneurs to communicate clearly about the investment opportunity and the associated risks. Treating these investors with the same professionalism as one would treat formal business partners is crucial. A noteworthy example is Mike and Jackie Bezos, who invested $300,000 in their son Jeff's venture, Amazon.com. That investment has grown to be worth over $8 billion today. Crowdfunding. Crowdfunding is an increasingly popular method, especially following the Jobs Act of 2012, which expanded the ability for everyday investors to participate in funding small businesses. This method allows for numerous small contributions from various individuals, transforming it into a viable source of equity. Unlike traditional crowdfunding, where backers might receive a token of appreciation, the Jobs Act allows contributors to become equity investors. Crowdfunding platforms like Kickstarter and Indiegogo have paved the way for creative funding, with the potential to raise up to $1 million per year for eligible businesses. However, presenting a compelling and relatable story is vital, as crowdfunding appeals more to narratives and ideas that resonate with the public. Accelerators. For inexperienced entrepreneurs struggling to gain initial funding, accelerator programs provide a unique solution. These programs offer seed capital, typically between $15,000 to $25,000, alongside mentorship and resources aimed at helping businesses transition from idea to execution. In exchange, accelerators often take 6 to 10% equity in the companies they support. Accelerators like Y Combinator and Techstars are well known in this space. They provide not just funding but valuable mentorship, significantly enhancing the chances of securing future investments. Angels. When personal networks and initial funding are inadequate, entrepreneurs frequently seek angel investors, wealthy individuals who invest in startups in exchange for equity. Angels fill a crucial gap in the market, often investing in businesses early on, long before venture capitalists enter the picture. With an average investment of $50,000, these investors seek promising ventures with high growth potential. Despite the risks, 52% of angel investments can lose money. There is potential for substantial returns. Angels typically target a return of 10 to 30 times their investment over a period of 5 to 7 years. The fragmented nature of angel investing can make it challenging to find these investors, but networking and leveraging local contacts can increase the likelihood of securing funding. Strategic investments through corporate venture capital. Large corporations increasingly engage in venture capital, investing around $2.2 billion annually in promising young companies. These investments can range around $3.5 million each and often serve dual purposes: financial return and the acquisition of innovative products or technologies. The strategic partnerships formed can provide startups with capital, technical expertise, and market validation, facilitating growth in competitive spaces. Venture capital companies. Venture capital companies, VCs, are private, for-profit firms that invest in early-stage businesses with high growth and profit potential. These firms raise funds from wealthy individuals, institutional investors, and corporations, aiming for substantial returns, often between 500% to 1,000%, over a period of 5 to 7 years. In the United States alone, over 400 venture capital firms actively invest in promising companies across various industries, with significant concentrations in regions like California's Silicon Valley and Boston's high-tech corridor, which together account for nearly 38% of all venture capital investments. Some educational institutions, such as business schools at the University of Michigan and Cornell University, have established their own venture funds to support businesses started by their students and alumni. The selection process for venture capital funding is highly competitive. On average, a venture capital firm receives about 1,100 business plans each year, but invests in only a small fraction, typically just 1% of those proposals. Many entrepreneurs believe their startups are worthy of VC funding. However, most do not meet the stringent criteria set by these firms. Once a plan is shortlisted, the VC firms perform thorough due diligence before making a decision. Typically, firms invest between $5 million to $25 million per startup to justify the high costs associated with screening proposals. In a typical year, VCs may invest in only 3,700 of the nearly 28 million small businesses in the United States. Venture capitalists usually purchase ownership stakes through common or convertible preferred stock and sometimes take controlling interests, which can dilute the founders' ownership. Entrepreneurs must weigh the pros and cons carefully, as a larger share of a well-performing company may ultimately be more beneficial than retaining a majority share of a struggling one. Investment phases typically include early-stage and expansion-stage investing, with only 2 to 4% of total VC funding going toward seed-stage companies. Moreover, VCs provide not only financial support, but also management advice and access to their extensive networks, enhancing the value of the businesses they fund. Control is another critical aspect of venture capital investment. Entrepreneurs often need to relinquish some level of control in their companies, as VCs generally want to safeguard their investments. Many VCs will take active roles by joining the board of directors or even recruiting a new management team. This can lead to tensions between the original entrepreneurs and their investors, especially if the invested capital is pushed for rapid growth that may not align with the founders' approach. Venture capital firms today are increasingly specialized, often focusing on specific industries or geographic regions. They seek businesses with a competitive edge, whether through innovation or an unmet customer need, and look for firms in high-growth industries with the potential to become significant players. Importantly, a viable exit strategy is essential for venture capitalists, typically planned within 3 to 5 years, through public offerings or acquisitions. The allure of venture capital comes with challenges, requiring entrepreneurs to consider their long-term goals before seeking such funding. Venture capitalists usually purchase ownership stakes through common or convertible preferred stock and sometimes take controlling interests, which can dilute the founders' ownership. Entrepreneurs must weigh the pros and cons carefully, as a larger share of a well-performing company may ultimately be more beneficial than retaining a majority share of a struggling one. Investment phases typically include early-stage and expansion-stage investing, with only 2 to 4% of total VC funding going toward seed-stage companies. Moreover, VCs provide not only financial support, but also management advice and access to their extensive networks, enhancing the value of the businesses they fund. Control is another critical aspect of venture capital investment. Entrepreneurs often need to relinquish some level of control in their companies, as VCs generally want to safeguard their investments. Many VCs will take active roles by joining the board of directors or even recruiting a new management team. This can lead to tensions between the original entrepreneurs and their investors, especially if the invested capital is pushed for rapid growth that may not align with the founders' approach. Venture capital firms today are increasingly specialized, often focusing on specific industries or geographic regions. They seek businesses with a competitive edge, whether through innovation or an unmet customer need, and look for firms in high-growth industries with the potential to become significant players. Importantly, a viable exit strategy is essential for venture capitalists, typically planned within 3 to 5 years, through public offerings or acquisitions. The allure of venture capital comes with challenges, requiring entrepreneurs to consider their long-term goals before seeking such funding. Venture capital firms today are increasingly specialized, often focusing on specific industries or geographic regions. They seek businesses with a competitive edge, whether through innovation or an unmet customer need, and look for firms in high-growth industries with the potential to become significant players. Importantly, a viable exit strategy is essential for venture capitalists, typically planned within 3 to 5 years, through public offerings or acquisitions. The allure of venture capital comes with challenges, requiring entrepreneurs to consider their long-term goals before seeking such funding. An initial public offering, IPO, allows a company to raise capital by selling shares of stock to the public for the first time. While this method can secure significant funds, averaging around $310 million since 2001, it also involves a complex, costly process with considerable regulatory scrutiny. The number of IPOs has declined since the dot-com crash and subsequent regulatory changes, making it increasingly difficult for smaller companies to go public. Investment bankers often prefer established firms that demonstrate high growth rates and scalability, along with 3 to 5 years of audited financial statements. The transition to a public company changes ownership dynamics significantly. Despite retaining some control, founders typically have less authority as management decisions shift to a board of directors. Launching an IPO is an attractive option for businesses that meet specific criteria, such as proven profitability, solid industry positioning, and a competent management team. As companies navigate these challenges, understanding various funding mechanisms, including venture capital and public offerings, enhances their chances of securing necessary capital for growth.
Thank you for watching. If you liked this video, please like and subscribe to channel.